This video is only for education purpose. Imagine waking up one morning and realizing that one of the biggest financial institutions in the world has completely collapsed. A bank that had survived wars, recessions, and decades of market cycles suddenly filing for bankruptcy. Investors froze, markets panicked, and within hours, global finance entered one of the darkest moments in history. In this video, we're going to break down exactly how the Lehman Brothers collapse happened, why it shook the entire US economy, how it triggered the 2008 financial crisis, and what beginners today can learn from this event to avoid repeating the same mistakes. We'll walk through the rise and fall of a 150-year-old company, the dangerous bets that no one questioned, the mistakes investors made by ignoring risk, and how the Federal Reserve, Wall Street banks, and the housing market all got tangled together. By the end, you'll understand not just what happened, but how events like these still influence the S&P 500, interest rates, and market behavior today. Stay until the end, because the lessons from the Lehman collapse are some of the most important lessons for anyone entering the stock market. Welcome to Crypto Brain Power, where we teach beginners about the stock market, history, market evolution, and long-term wealth building in a simple and practical way. Every video is designed to make complex financial topics easy for anyone to understand, no matter your background. Now let's get into the story. Lehman Brothers wasn't just another bank. It was a symbol of stability for more than a century. Founded in 1850, it survived global wars, oil crises, and recessions, slowly growing into one of the most respected investment banks in the United States. By the early 2000s, Lehman had become a major player on Wall Street. But behind the scenes, the company was making extremely risky bets on something most people never questioned: the U.S. housing market. At that time, real estate felt unstoppable. Home prices kept rising, lending standards became weaker, and banks kept handing out mortgages to people who couldn't actually afford them. These risky loans were called subprime mortgages. Lehman Brothers didn't just invest in these mortgages, they built complex products out of them, bundled them together, and sold them as safe investments. On the surface, everything looked profitable. Investors believed housing prices would never fall. That belief alone created a bubble. For beginners in the stock market, this is a key lesson. When everyone believes something can never go wrong, that's usually the moment risk is highest. As the housing boom continued, Lehman increased its exposure. The company borrowed huge amounts of money so it could buy even more mortgage-related assets. This is called leverage. Leverage can multiply profits, but it also multiplies losses, and in Lehman's case, the leverage was massive. The entire business was sitting on top of fragile debt. Around 2006 and 2007, cracks began to appear. The Federal Reserve had raised interest rates, making mortgages more expensive. Homebuyers started missing payments. Foreclosures increased. Housing prices stopped rising and began to fall. Suddenly, the assets Lehman had invested in weren't worth what everyone thought. The value dropped, and the losses started to grow. Companies like Apple and Amazon faced challenges in their early years, but they had strong business models that produced real value. Lehman, on the other hand, was dependent on financial engineering and short-term borrowing. When confidence disappeared, its foundation collapsed. By early 2008, investors were questioning whether Lehman really had enough capital to survive. The U.S. financial markets rely heavily on trust. When trust breaks, even strong companies can face trouble. Platforms like Robinhood or Fidelity today rely on the same confidence. If customers suddenly believed their money wasn't safe, panic would spread instantly. That's exactly what happened to Lehman. As losses grew, Lehman tried to raise money, find investors, and sell risky assets. But no one wanted to buy something that was rapidly losing value. The government had already stepped in to save Bear Stearns earlier that year, but when it came to Lehman, the government refused to provide a bailout. Without buyers, without support, and without confidence from the market, the company had no choice. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history. Immediately, markets around the world reacted. The Dow Jones dropped nearly 500 points in a single day. Liquidity dried up. Banks stopped trusting each other. Companies like General Motors and AIG also faced serious pressure. The U.S. jobs report that followed showed massive layoffs. It was a chain reaction that spread through the global economy. The collapse didn't just hurt investors. Ordinary people suffered. Millions lost jobs, homes, and savings. Retirement accounts fell sharply, Even the S&P 500 took years to recover. A useful comparison for beginners is looking at the difference between investing in a stable company like Apple, which builds long-term value, versus investing in overly complex financial products you don't truly understand. Apple sells iPhones. Tesla sells electric cars. Amazon delivers everyday items to your home. Their business models are easier to understand. Lehman's products were so complex that even many experts didn't fully understand the risks. One common mistake beginners make is thinking a rising market will rise forever. Another mistake is not understanding what they're investing in. If you put money into something because everyone else is doing it, you're following the same psychology that led to the 2008 crisis. So what can beginners learn from the Lehman collapse? First, always be aware of leverage. Companies or individuals who borrow too much are vulnerable when conditions change. Second, don't rely on hype. If something sounds too good to be true, it probably is. Third, don't ignore risk. Even the biggest, most respected companies can fail if they're built on weak foundations. And finally, long-term investing works best when you choose businesses with real value, steady cash flow, and strong fundamentals. Today, platforms like Charles Schwab, Fidelity, and Robinhood make it easy to invest, but they also make it easy to take risks without realizing it. That's why understanding financial history, like the Lehman crisis, is so important. It helps you think more clearly, stay patient, and make more informed decisions. As we wrap up, remember that the Lehman Brothers collapse wasn't just a single event. It was the result of years of ignoring risk, excessive borrowing, and assumptions that the market would always rise. For beginners, this story is a powerful reminder that long-term investing isn't about chasing fast profits. It's about understanding what you're buying, managing risk, and staying informed. If you found this explanation helpful, subscribe for more educational videos that make finance simple and easy to understand. Educational purpose only, not financial advice.